Good morning, good afternoon, or whatever it is where you are. This is Kyle Teixeira and John Teixeira again, and welcome back to We Are TPM, where we are local property managers, real estate experts, we're going to go over topics that involve our experience in real estate and just share all the knowledge we can with you. This week, we are going to be talking about using your retirement account for real estate investing, or retirement funds for real estate investing, I should say. But if at any point in this podcast we say anything that interests you, brings up more questions, or really just want to talk to us or have a consultation about any of our topics or services, shoot us an email at showmethemoney@wearetpm.com or give us a call at 817-818-9147, and let's get into the topic.
Let's do it. Using retirement funds for real estate investing it sounds like a boring topic, but and really it's really a narrow topic for specific people that can do this, right? And but we talk about it a lot in our conversations.
Yeah, it's an assumption first that you have retirement accounts or retirement savings, right? That's step one, and now
that's right.
Just giving you advice on how you can leverage that to do both.
Well, as we on this podcast try to stay focused on finding ways to share with people how to build wealth with real estate investing, right? Mm-hmm. And give them little tips and tricks. We thought talking about this and expanding on this subject a little bit, since we kind of gloss over it all the time, would be a great idea. So let's get into it.
Yeah, we gloss over it because it's not the most entertaining topic, but it's also one that nobody really thinks about or knows about, or sometimes even thinks that they have that leverage to be able to do this. So
well,
that's why we get into it.
You know what? The truth of the matter is also we are not CPAs. We're not tax accountants. We're not financial advisors. We're none of those things. So as we talk about this thing, make sure that if you're out there listening, you're just getting the opinion of a couple of property managers. Take it with a grain of salt. We'll give you our knowledge and our experience. But we aren't those, financial advisors and tax accountants.
Yeah, we're giving you the info to go talk to somebody who can, make these things happen for you. So,
love it. Let's get into it. So I want to talk about what most people, the most common retirement account is an employer-sponsored 401k account.
Yep, correct. A lot of people have them. A lot of employers offer them. And by employer-sponsored, you mean it's through your employer. It usually comes out of your paycheck.
Right.
And whether they match it or not, that doesn't mean it's not still employer-sponsored.
Right. No, you're exactly right. Usually, nowadays, I don't know this to be fact, but I believe that these are becoming more and more rare. Right? Like it's not as common as it used to be for employers to offer these, but they're still offering them. It's still a common thing, especially for larger companies to have. In my opinion, if you work for a company that offers a 401k account, you should totally be taking advantage of it as much as you possibly can.
Mm-hmm.
Right?
Yeah, because there's advantages to it if they match it. There's no reason not to, because Absolutely. It's the only way you get free money that compounds, right? Compound interest is the name of the game, and when it's not only your funds, it's theirs. It helps in the long term for sure.
So if you're listening and you don't understand what Kyle means by matching it, basically what that means is you save a certain amount of money out of your account, and your employer matches a certain percentage of it. Sometimes 100% of it, sometimes it's 25%, it's whatever. They're all different. Mm-hmm. But they may say, hey, for every $1 that you save, we're going to give you another 10 cents.
Yeah, and it's a double whammy because it's a pre-tax deduction. Right. So it comes out before your money gets taxed.
Right.
So essentially it's a tax shield that's getting matched by your employer. So $100 of, say it's 100%, $100 of your untaxed money, and then $100 of your employer's goes into this 401k pre-tax. So
when we tell people that they can use their retirement funds for real estate investing, we better clarify regarding this class of retirement fund, because
there's a lot of different ones out there.
There's a lot of different ones out there, and we're going to get into a couple more, but This particular one, the employer gets to direct where funds can go, right? So you're given a list of options, a list of different instruments, investment instruments that you can choose to move in and out of, but you're limited by that, what your sponsor chooses, right? And so there's usually not a real estate fund or a real estate, there's not an option for you to directly invest in real estate within that 401k.
Well, you say there's not. It's less common. It is more common recently that they're moving to more customizable 401k plans. But your point is that you're limited to what the sponsor offers, and commonly that's not included in there. So
yeah. I would even go as far as to say that it would be too difficult for an employer to include that type of single property investment that we're talking about into their portfolio. So that's just the chances of that happening are extremely low. And I would,
unless they're doing I'd say it's relatively new. More relatively new to being adopted is the self-directed employer-sponsored 401ks. So that gives you a little bit more freedom of you control where it goes. They just still sponsor it. So if you're lucky enough to do that, you might have some real estate options in there.
Okay, so self-directed 401ks are for self-employed people. So we're going to get into that.
There's a hybrid. That's what I meant. But
all right, so we're going to get into that a little bit down the road. But so what can we do with this? If we got this employer-sponsored 401k, we can do a couple things. Hopefully, maybe they do have an investment fund, right? Like a fund that's set up that's real estate related. That is a possibility, but you can borrow against it, right? You can leverage against it to go buy real estate. It won't be necessarily in your IRA, but you can leverage those funds that are in your IRA, or not your IRA, your 401k. You can leverage those funds to help you purchase that real estate as a separate investment.
Yeah, and that's part of the whole, I called this pre-tax earlier. I'm not going to speak of the definitive terms of a 401k, but the general idea is it doesn't get pulled out until you hit that age mark. If you do pull it out, there's a tax penalty and all that stuff. So the idea is this money is supposed to sit in there till retirement. That's why they allow you to leverage against it and give you a loan against it, because there's a high probability it's going to be there as collateral.
Yeah, I've had a lot of my clients do that to purchase their primary residence. Mm-hmm. I haven't had a ton do it to purchase investment property, but that doesn't mean you can't do it. People just don't think to do it. They're afraid. I think people are kind of afraid to use their funds. They see it build up. It's kind of exciting to watch your retirement fund build up. The last thing you want to do is do anything to make it go down real quickly, right? Even though that real estate investment, if you pulled money out of it to put into a real estate investment, that real estate investment is going to give you much greater returns. Mm-hmm. But you don't get to see that in a statement every month. And I think that's what holds people back from doing it a little bit.
Yeah, sometimes the confidence in what you see can hold you back from what you can actually achieve, right? And conquering that is part of what this is using what you've already gotten and what you've already acquired to acquire more. So sometimes that gives people more confidence. Sometimes not.
Let's get into our next kind of subject would be old 401ks, meaning they're no longer sponsored by an employer. So you've got this 401k still from an old job, right? You haven't done anything with it. It's still just kind of going and doing its thing with no new contributions to it. You can still use that. Most importantly, the best way to use it if you're planning to do future real estate investing is to turn that into a self-directed IRA. Mm-hmm. Now, that's different than what you referenced before, which was a self-directed 401k for self-employed people. But the IRA, anybody can use, right? Maybe we have a new job, but we've got an old IRA from an old employer. I can turn that into a self-directed IRA. Now I've got way more power to buy real estate and do some things
Mm-hmm.
within that IRA that I couldn't do when it was an employer-sponsored 401k.
Yeah, and you always want to look at the cost reward of what when you transition something. Don't just do it. Talk to somebody and get some advice on what penalties or drawbacks there might be. And like you said, you get a new job, you get a new 401k. Doesn't mean you can't roll your old one into your new one to let that one compound even better. So.
Yep. And you should be talking to somebody about all of this stuff. Somebody that is, preferably licensed, and somebody that can give you great advice about what to do with your IRA. We're just giving you some ideas regarding investing it in real estate. So with this self-directed IRA, you can actually go buy real estate and have it sitting in the IRA. So you get all the same benefits. Let's talk about some of those benefits. For one, well, why would you do this, right? Why would you take money out of your IRA or use the money or leverage it to do this? And I think the biggest reason somebody would do it is because they need the capital. It takes a certain amount of capital to buy a piece of property. Nobody's giving you a piece of property without putting anything down. So I think capital need is the biggest one.
Yeah, capital need is usually the biggest one for any time money moves around anywhere, right?
That's exactly right. How about tax advantages? Tax advantages that allow that income, like you had mentioned, to be tax-free, so that while that rental property is sitting in that IRA, its income is being treated just like any other income in that IRA, and it's tax-free or deferred depending on how you have it set up. You could have that set up as both a traditional IRA or a Roth IRA. You can do self-directed with both types.
Yeah, Roth IRA is more structured, similar more to a 401k with the time period, penalties, and all that stuff. So yeah, you definitely want to make a decision based on what your time horizon and goals are.
So the other biggest benefit that you get from doing this in this self-directed IRA is you avoid capital gains when you sell the property. So if the property is still sitting in that IRA, you sell it, you're avoiding capital gains taxes. So all of that is still taxed. Just like all the other income in that IRA would be taxed, it's treated the same way. But the rest of us, when we sell an investment property, we have a capital gains tax that we have to think about and plan for. And you won't have to do that in this case.
Yeah, that's true. I mean, it's just a different way. It's significantly lower if it's set up correctly is really what the advantages are there. Because those capital gains taxes can slap you, and they can slap your pocketbook when tax season comes around, where that kind of protects you from separating that out across that portfolio as is your desire when you have assets all tied into one portfolio. So just kind of have a shared interest instead of putting everything on your own back, I should say.
Yeah, well, actually, that dovetails real nicely into what I wanted to talk about, mortgages, right? Regarding getting a mortgage within this within that IRA or trying to do it within your retirement account. I actually learned a lot looking into this about non-recourse loans. So our traditional mortgage is what's known as a recourse loan. The mortgage company has recourse beyond the asset to go after your other assets if they wanted and needed to. And all of our Fannie Mae, FHA, VA, all of our loans are recourse loans. They all operate that way. It's actually difficult to find companies that will do what you would need in this case, which would be a non-recourse loan. That's the only way to get a mortgage within an investment property. So now you're going back to either paying cash for it or buying it outside of the investment property and just using that retirement funds or leveraging the retirement fund to buy the property, right?
And essentially what you're saying is the non-recourse part means that asset is all that's backing that mortgage.
Exactly right.
Outside of that, there's nothing else for them. So, and
It's
you probably see why that's not the common method, because any bank, any loan that can, or any underwriter as well, that's reviewing a deal like that, wants as many guarantees as they can get. Right, that's where recourse comes in.
They're taking higher risk, right? So here's what I learned about these loans: they're at a higher interest rate than a traditional loan. So I don't know how much higher, but they're definitely at a higher interest rate. And the down payment on those loans are like 40% versus, your standard conventional loan is 20%. I can buy, if you're buying an investment property, you're most likely putting 20% down. So you're putting twice as much capital down just to get this mortgage within this investment product, and getting those tax benefits. So maybe for a really large, high value property, it might still be worth it to do this, but you really have to weigh the
Well, and over time, that weight would be a lot stronger, because if you're avoiding capital gains on a very big capital gains and appreciation on a property that maybe you sold after 10 years and transfer that into that 40% down payment, then you're not looking at it as a high amount lost. You're looking at, or high amount put forward. You're looking at it as a high amount put forward to the new property instead of the IRS. So
sounds like a 1031 exchange. We need to talk about those in the future too, don't we? So, anyways, the other thing about those getting a loan in there is it kind of complicates some of the tax breaks also. So some of the tax breaks that we talked about that you get, it kind of complicates those as well, those tax breaks. And maybe we didn't go over them actually, but there's income tax breaks, the capital gains tax breaks that you get by being in there. So getting a mortgage complicates those. And when I say complicates it, I read some things that from people that say that there's kind of some workarounds, but it doesn't sound easy. Sounds like you need to know what you're doing. You definitely need to have a professional helping you if you're going to go that route.
Not going into the details on that one, huh?
Nope.
So,
sounded too complicated.
Yeah,
nope.
For sure.
So anyways, you know what? Kyle, that's it. That's what I got on anything you want to share about using your investment properties to help.
Yeah. I mean, what I want to say on that is the mindset around your retirement, right? These days, everybody less people, especially less people my age, focus on getting retirement accounts, getting set up for retirement. These accounts themselves are set up for, like, some of them 56 and a half or 65 and a half, whatever it may be. But then there's the whole thing about how people are retiring way later, and that's a pretty early age these days, where if you pull it out, then that money's going to run out. If you live till you're 90, 100, whatever it may be, but retirement accounts don't have to just be an account. Those exist, and you're putting money into them because you want to be protected at retirement. That's what I say about that, is transferring portion of it isn't just into real estate, isn't just diversification. It's also better longevity, because that's going to keep growing and give you your cash flow dividends, regardless, on a monthly basis or whatever basis. The more of you get from that, you actually get money in your pocket for retirement, as well as an account set up growing with, say it's in an IRA or it's in a 401k. That's one portion of it, but having it diversified, I think, is very important. So
that's a great point. And I kind of want to recapsulate a little bit what you just said in kind of my own words. I like to put things a little bit simpler sometimes. And that is converting what I think you were articulating there was converting that investment account into a real estate investment will actually net you more toward that goal of retirement, right? You have that account for retirement so that you have money every month to live off of. Well, taking that money that's in that IRA, that 401k, whatever product it's in, and actually using it, pulling it out, leveraging it, or just ending it and converting it and sucking it up and paying the taxes, and putting that into something that's going to net you far more and benefit you far more when it's time to retire at 60, 65, 70 years old, whenever you do that, seems smarter, doesn't it? I think the problem people have a lot of times, Kyle, is they over focus on the negatives, the short-term negatives, right?
Yeah. Well, I think that's a huge problem because it's not just in all investments, risk management is important, right? But a lot of the risk management we talk about is financial risk management and financial analysis of risk management. There's also risks in the world and risks in your
Walking
retirement.
off the curb.
Yeah, exactly. There's risks in what will happen in the next 70, 80 years if that's your retirement horizon, right? And real estate is one of the safest, I'd say, when you look at the risks outside of the financial aspect. Real estate, regardless of what is happening or what happens in the world ever, it will be valuable, right? We could have an apocalypse, and if you can claim your say to land, it's worth something, right? So there's always value in, I go really worst case, right? But probably farther than I
even the zombies need
the zombies need somebody to sleep. But the point there is, 401ks, Roth IRAs. A lot of that money is safe, but it's still put into markets. It's still put into commodities.
Something more volatile than real estate.
Yes, exactly.
So real estate will always be less volatile. I pulled this quote off of, I think I got this off of a website called Million Acres, and I wanted to I thought it was interesting. Real estate is the best performing investment in modern history. It is a billionaire factory.
Mm-hmm.
And that's kind of nutshelling what we've been talking about throughout every episode of this podcast. We've been trying to help people explain why real estate investing is such a strong tool for building wealth.
It is, and you have to value the things you can't see, like we were saying at the beginning. You don't have to measure all the time and constantly have access to that measure of wealth to have confidence in its effectiveness or in its appreciation. I saw a very interesting, I forget what it was on. I saw something very interesting a couple weeks ago about billionaires and their net worth, right? We throw the Forbes list and all this stuff that get thrown out with these net worths. You ask these guys directly what they're worth, they don't know. They honestly do not know. That's because
it fluctuates day to day.
It fluctuates at massive scales that they can't tell you and can't be considered. And because they don't value the measure of it, they value the existence of it.
Right.
Well,
it's the same thing we do with real estate, right? Mm-hmm. Like if you tell me the value of a piece of property went down, last month I don't care. Because I'm not planning on selling that next month. I'm planning on selling that in 10 or 15 or 20 years when it's going to be worth way more, right? Mm-hmm. The only downturn I can recall in my lifetime since I've been owning real estate really is 2008. We had a small blip in the early 90s, but 2008 really was the only downturn that I recall. It only lasted 2.5 years, right? If people had... Back then, when they were so focused on the short term, freaking out, the world's coming to an end, if they had that hindsight perspective to see that, no, not only is it not coming to an end, but this is going to be a good thing for us, and from here, we launch. And in 2.5 years, you're back to where you were, and 7 years after that, you have, an additional 25, 30% of equity in your home. Just write it out and be patient. That's even more true with real estate than it is in the example you used for all the other investment instruments out there.
Yeah, and it's all those are short-term worries, right? Like those are changing. Those times are getting shorter and shorter as the markets get more involved, people get more active, they get more volatile. Like, you mentioned '08 as a small blip. You go watch The Big Short. That started in '06. These guys noticed it in '06. It didn't crash till '08. It came back by 2010. We knew about COVID in December. It didn't crash the market till March. It came back by August. That's 6 months now. you can't live in the short term if your desires are in the long term. Those have to go in line.
Yep.
And real estate helps you do that. So,
yes, sir. Hey, good conversation, Kyle, about using your. Let's wrap this conversation up, because I feel like you and I are on the same page when we kind of nutshell this conversation. If we really simplify it and nutshell it, I think it's a really smart move to make the decision to use your IRA, your retirement account funds in some fashion, in any fashion that you deem appropriate for you, whether that is pulling some out, leveraging it, or just shutting it down and converting it into something else. I think it's really smart to do that, because real estate is going to be safer and get you better returns than that retirement account is. I am a big proponent of diversification. So I'm not telling you shut all your retirement accounts down. But if you told me that that's the decision you made, I guess I wouldn't hate you for it.
Yeah, I mean, and I don't disagree with any of that. I'm big on diversification. I still have retirement accounts in addition to real estate, in addition to short-term investments. But that's the point, is know what you have, why you have it, and what you're going to do with it. That's probably the most important thing. And it's not about the amount. Like, sometimes it's less stressful to own real estate, and that would definitely be up for debate. But when you can go look at your retirement account every day on your phone and analyze it and question it and get some stress in, if you can't do that for real estate and that matters to you, then go do that. One of the worst calls I'm not going to say worst calls, this bad for your psyche calls that we can get is like, you hear the market's hot, you talk to your wife or whatever, there's not a chance in hell she's going to let you sell that house. She doesn't care what it's worth, whatever. You still call your realtor and say, hey, what's it worth? I just want to know. I'm not selling. I just want to know the exact amount that I could have got, so that I can stick in my head for the next 3 years and I can kick myself for not doing it, or what I could have got. Like, just don't, all investing psychological. Mm-hmm. Try to play around the game as best you can is my advice, because
it's just like getting a portfolio statement every month, right?
Yeah.
Like, you get to look and see what your net worth is, and that's part of what makes you feel confident about walking in the world. And when you walk into Best Buy and you're about to buy a new 75-inch TV, if you just got done looking at your statement and you've got $450,000 in your IRA account, it makes you feel a lot better about dropping $1,200 on a TV that maybe you need, maybe you don't need. And if you don't have those things, you think a little bit harder about dropping that money on that TV, right? I mean, that all affects how we walk around in life.
Yeah, and sometimes it's for the negative, because like what you said, I'd still advise the negative, because while that made you more confident, it's still your retirement account you can't touch for another 30, 40 years. So how did that change your ability to buy that TV?
I think what I tried to do was describe consumer confidence, and that's kind of what consumer confidence is how is our money doing?
Well, I guess what I'm describing is, with the proper mindset there, you don't buy that TV and you put that $1,200 next week back into the retirement account, and all that compounding of mindset and money for 30 years, you have a lot more at the end of it. So
I think it's the pink shirt that's making you think that
shirt.
way.
Yeah, I think it's the pink shirt. Maybe it's your green shirt. So we got called Cosmo and Wanda on our way out here. So.
We did. Green is the color of money, though. So, all right, let's wrap this up, Kyle. Get us out of here.
All right, thank you guys for joining us again. We are TPM, and y'all have a nice week.
Do we have a show me the money call out?
Of course. Always show me the money.
If you
want me to show you the money with your portfolio, or figure any and all this stuff out, send us an email at showmethemoney@wearetpm.com, or give us a call at 817-818-9147.
Hey, the purpose of that email address, by the way, is if you are sitting out there listening to us, and I don't know why you're listening to us, but if you are, then and you've got some investment properties, we really want you to just shoot us your addresses so we can help you analyze what you're doing with those investment properties. I've been doing a lot of this lately, haven't I, Kyle? I've been helping people and analyzing their portfolio and being able to go back to them and say, look what we would be able to do for you if we were managing this for you, and taking that stress of managing that property or those properties away from you at the same time so you can focus on acquiring more properties or whatever else. You're building a business. Taking the energy that you're expending away and making you more money. That's the purpose. Show me the money at wearetpm.com is just a place for you to send us your property, send us your portfolio, so we can do a quick analyzation and share with you how we can help.
That's our goal.
Love it.
We are TPM.
We are TPM. We out.
We out.